Hello viewers, welcome back to our next episode of our YouTube channel, KC Accountants Education Center. And right now I want to proceed from where we stopped. In the previous video we had started looking at securities or financial instruments and financial markets as our third new topic. So I had promised you that we are going to kickstart with finance decision. So let's go ahead, the finance decision. So we said as a finance manager or as a CFO of any organization, you are supposed to make decisions. And these decisions, they include investment decisions, or what we call the capital budgeting decision. Capital budgeting. Two, of course, for capital budgeting decision or the investment decision, it's where decisions that are involving things to do with long-term assets. Long-term assets the firm can invest in, or the firm can invest into, and when you're done investing in those assets, then you'll be able to see the different other decisions that you can make as a finance manager. So the other investment decision that the other decision that you are supposed to make as the CFO, you are supposed to do what you call the finance decision, where you have to look for the money to finance those investment decisions that you have analyzed in part one, or investment in this first decision of investment decision. So you have to be able to look for the finance or the different sources of finance that are cheap at the business, but they can also be used to generate more wealth to the organization by investing in these investment projects that we have evaluated under the capital budgeting decision. So the second decision is to look for finance to finance these investment decisions. The other, you are supposed to do what you call working capital management. And we know that working capital management requires you to manage of course, as you make investments, as you decide on which investment ideas to put your money into, as you look for the money to finance those investment ideas, you are supposed to make sure that you have some capital that you can use to run the day-to-day operations. And these day-to-day operations, they're the ones that you will need what we call the working capital sources. They are the ones that we need to make sure that we manage our day-to-day operations. So we do what we call working capital management. And finally, the other decision is to make decision about dividend decision. Dividend decision. So these are the four main finance decisions that any CFO or finance manager can undertake. But when you look at this working capital management, for working capital management decision, it's not on our syllabus here for advanced financial management, but it's something that we looked at on level 2 under financial management. And our focus is going to be on these other decisions: the dividend decision, the finance decision, and then the capital budgeting decision, or what we call the investment decision. So all our emphasis is going to be on these three decisions as per the syllabus. So we shall see how we deal with these three decisions. Now, when we talk about investment decision, this first one, we are trying to look at the sources of finance that we can use as a business. Now, first, we need to understand the sources, the different sources, because it is these sources of finance that we are going to use to finance our investment decision. So we need to first understand the fact that these sources of finance, they are divided into what we call different categories. They are divided into two. We have what we call the long-term sources, and then what we call the short-term sources. We have the long-term sources and then the short-term sources. That is the first two divisions of these sources of finance. However, when you are looking at finances, when you are looking for finances, in other words, when you are looking at the financing decision here, we are basically looking for finances to finance our investment ideas or investment decisions. And the investment decisions, they are always long-term. So that's why we are taking only those sources that are going to finance our investment ideas. And those sources must be long-term sources of finance. So these short-term sources, they are the ones that we use to finance our working capital sources or working capital management. But when you are looking for finances to finance investment decisions, as we say that these investment decisions, they are long-term in nature, and that means that our focus is going to be at 99% on these long-term sources. Otherwise, the examiner will basically, maybe if the examiner prompts us to have a look at maybe the short-term sources, but as our concern is to look at the long-term sources, maybe if the examiner points it out, but we are going to basically look at the long-term sources of finance. However, the sources of finance, these different sources, we've said they are divided into long-term sources and then the short-term sources. But I also want you to understand that these sources are further subdivided into different groups or categories. So they are also further subdivided into two. So when we look at, if we are basically focusing on long-term sources of finance, these, you should know that they are further subdivided into two. We have what we call the debt finance and then the equity finance. But get my point that I'm only focusing on the long-term sources of finance. But as I said, they are further divided into the debt finance and then the equity finance. Therefore, the examiner will expect you to know that we have a debt finance and at the same time we have an equity finance. So we need to know the different options that we have that are going to be categorized as debt finance and those that are going to be categorized as equity finance. So we can mention some of them. If we start from maybe the equity component, if we start from the equity component, we can start with the retained earnings. I know retained earnings can be short term or long term. Retained earnings, we can go by common stock or ordinary shares. This is basically how what MTN did recently, and Airtel, they went to issuing shares to the public. Those are ordinary shares. We also have, but we know from the retained earnings, it is the one that is very key, because if you do what you call the dividend policy, then you may decide to retain all the profits that you have made, or you may decide to give out dividends depending on the dividend policy that you have. The other that we can talk about, we can look at maybe venture capital and others. There are very many. I'm just highlighting few for us to remember ourselves. But whereas for the debt finance, if you look at the debt finance, on the side of the debt, we have what we call the term loans. These are long-term loans or bank loans. We call them term loans. And here we are referring to long-term finance sources. We have what we call debentures or bonds. You can call them debentures or bonds. Sometimes if they don't call them bonds or debentures, they can call them loan notes. Loan notes. But the examiner prefers to call it either debt or either bonds or debentures. But both of them, you may actually find both of them in the capital structure. You may find when you have a bond and at the same time you have a debenture, because it's like having loan 1, loan 2, loan 3, but they are all related to debt. Then the other, we have what we call the preference shares. We said preference shares is debt because we go by the legal definition of what a preference share is. Because preference shares, they are assumed to be repayable at the end of the useful life. In other words, they have a redemption period when we are supposed to make payments. We don't look at that. I know from your financial reporting or financial accounting, you know it can either be redeemable or irredeemable, but the general thinking here is that we go by the legal definition. Although if you bring in the other aspect of financial accounting and financial reporting to classify whether preference share is redeemable or irredeemable, it can be either debt or equity. But here we generally take it as debt. So when it is redeemable, it's supposed to be debt. When it is irredeemable, then it will be equity. That's another kind of argument. But here we are basically looking at these different aspects. Now, the examiner will bring a question. We've seen the different items that we have in all of this. Now, the examiner is going to bring a question. And the examiner might ask you to discuss the different sources, just like the way we've highlighted them. And then he may tell you that you provide the merits. They can give you to give the advantages of debt finance over equity, or advantages of equity over debt. Or it can be very straightforward. What are the advantages of debt finance, or what are the disadvantages or the advantages of either debt finance or equity finance? But my argument is to look at a scenario where they have told you what are the advantages of debt over equity. In other words, you don't just look at the advantages, but you look at the advantages and you look at you look at the advantages and then the disadvantages. You compare and be able to compare and contrast. So that's what I'm going to put in context. So if we want to know the advantages of debt finance over equity finance. In other words, the examiner will be trying to ask you, like, is it more important for someone to use more debt in their capital structure than using equity? Is it more advantageous to use debt finance than equity finance? That's the kind of question that I want to look at. One point we can give, it's cheap. It's cheaper compared to equity finance. Now, you don't just, this answer is correct, but if you just give it and you leave it like that, it will not make any sense. You have to go ahead and explain. Now, if you look at the equity financing realm, those issues to do with issuing shares, you know, you have to advertise for people to come and buy shares. You have to hire specialists, lawyers, brokers, and you have to get through different licenses, getting listed on the stock exchange for you to be able to issue out shares to the public. There are very many costs that you are going to incur in relation to raising equity finance. But if I want debt, I can just go to the bank, we sign up an agreement. The costs, they are not all that high as compared to equity, because with the loan they may tell you are going to pay application fee of, let's say, 10,000 shillings or 5,000. It may actually be even free. Then they may tell you that we have some processing fee of, let's say, 1% of the loan amount, and you find those are the only costs that you are going to be incurring, and they will process the money faster. But going in for equity is a bit long term. Like, you have to first get listed on the stock exchange, you advertise, you are not going to sell the shares yourself, you are going to hire experts, stock brokers, who are going to actually help you go through that process. So it is very costly. Now, it is going to be very costly as compared to debt finance. The other that we can talk about is the fact that interest expense is a tax deductible. Interest expense is tax deductible under debt finance. In other words, when you borrow money, the taxman is going to allow you to expense interest to expense interest before you pay taxes. Remember, when you look at when you're preparing your income statement, you first get the earnings before tax. For you to be able to get the earnings after tax, or even earnings before tax, you must have expensed interest first. So for you to reach to this earning before tax, you must have gotten EBIT, that is earnings before interest and tax, then minus the interest expense. When you less off the interest here, then you can get your earnings before tax, where you can apply the tax rate and then you get the earnings after tax. So the tax authority is allowing you to first expense, because the interest is the cost for the loan that you have borrowed, which is not the case. Remember, dividends are only deducted after you have computed your tax. In other words, dividends are only paid out from the earnings, the profit after tax, or the earnings after tax, meaning the dividend is not going to be allowed as an expense by the taxman. Even in the business computation, it's not allowed, but interest expense is going to be allowed. That's an advantage, because if they allow you to deduct interest expense before paying tax, it means that they are technically charging you a lesser tax. Otherwise, if interest expense wasn't tax deductible, you would be paying more taxes. But since they are allowing you to first expense interest, then you will be paying a lesser tax, because the tax percentage will be computed on a lesser figure. So that's another point. The other that we can look at, so I hope you've got this point, that interest is a tax deductible. The other that we can look at is delusion of control. Delusion of control. Delusion of control. In other words, we don't dilute the control of the organization. When you borrow money as debt finance, it is going to come, and you will not call the bank to come and start looking at how you are doing your operations. For them, what they want, borrow the money, pay back their interest, nothing else. They don't interfere within the organization control. But what happens if if you get money from equity participants, like you issue more shares? When you issue more shares, it means you are bringing more shareholders, or you are adding more owners to the business. And these owners, they can determine what is supposed to be done through their annual meeting. They can dictate through the meeting of what they are supposed to do. So it dilutes the control, because you are going to be adding very many people that are going to be coming in as a result of buying more shares. So there are very many answers that you can talk about, but for now I want us to look at something else. As long as you don't just, because there are very many advantages, but you have to see those advantages that are more important than the equity components. So we can now look at the factors. What are some of the factors or the key considerations in choosing the capital structure or the finance choices? How do we choose, or what factors are they influencing the organization's finances? There are factors that are going to cause an organization to have more of debt than equity, and there are factors that are going to let an organization have more equity than debt. So let's look at what are the major determinants of the different sources of finance that a business can have. So we are looking at the factors, or what we call the key considerations, key determinants. Key determinants in choosing the capital structure. We say the capital structure is just a combination of the different sources of finance. Capital structure, what we call the finance choices. Factors that influence the finance sources. So we can talk about few of them. One, we can talk about the availability of the source, availability of funds. How that source is available matters a lot. Now, the source must be available. If the economy is very bad, then you don't expect that you will be able to get money from the public. If people are unemployed, the inflation rates are high, the disposable amount, the purchasing power is very minimal, the economic crisis, people are tied up, they don't have money. So you don't expect that you are going to raise, however much you advertise, you will not be able to raise the funds that you need from the public. So if that's the kind of situation, then you have to make sure that you go to debt. You substitute yourself to debt, because equity finance is not available at the current situation. Number two, we can look at the duration. Most of you, when let's say you go and borrow money, maybe from the bank, they might give you a loan of, let's say, 3 years, 3 years or 3 years to 5 years. But you find that you've gotten a loan that is going to take 3 years or 5 years. But the purpose for this money was for you to invest in a project that is going to generate cash flows after 10 years. Will you go for that kind of loan? Of course not, because the loan is going to end without you recouping the cash flows that you anticipated. So if they can't adjust the loan duration to the period of the project, then you shouldn't take that loan, because it will not help you. You have a project that will take 10 years to start generating money, but you are going in for a loan of 5 years, meaning you will start even paying, you will be paying the loan on the capital that you have borrowed, because by the time you start paying, the other money is not started to, the business has not started to generate the cash flows. The other that we can talk about is in terms of whether we are going to be having a fixed or a floating interest rate. Now, fixed or floating interest rate will also force you to either take debt or leave it. Now, when you are borrowing, there are these two rates. There are two different types of interests, where you can borrow on a fixed rate, and probably in Uganda, it's a bit hard for you to borrow on a fixed rate because of the high inflation rates. No one can give you money and the interest is just fixed, because if the inflation rates are high, then it's going to lose value. By the time you are paying back, the bank is not benefiting. So what they do, they use a floating rate, whereby the percentage keeps on changing, either increasing or decreasing based on the available circumstances, economic circumstances. So all of these rates are good, but when you're borrowing and you find maybe you're borrowing, let's say, from a developed countries, if they have that capacity of giving you the loan at a fixed rate, please go for it, because a fixed will be fixed forever until you pay it. But if it is rotating, just imagine if it keeps on increasing. By the time you are paying back the money, you find you are paying huge. So if you have a chance where you can get at a fixed rate, you can go for the fixed. But if the economy is unpredictable, then you can have a floating, more so in the developing countries. The other that we can talk about, of course, if you see that these two rates are not applicable in your location, then you can opt to go for to go for equity, depending on the rates that you are supposed to be paying to them. The other, we can talk about the security. The security and covenants. Now, covenants are very important as far as business is concerned on either side. And it is very rare to get money without a security. Securities and covenants, they move together, but they are a little bit different. It's hard to get good money for business without having a security. The security can be company assets, or it can be the cash flows that you anticipate to receive from the different activities. Now, what is going to happen is the fact that these people, they may give you the loan and they say, we are putting some covenants, restrictive covenants, that you shouldn't sell off these properties that you have secured against the loans that we have given without our consultation. You first consult us before you sell off the items. Or they can even restrict you from getting other money from different sources before you complete theirs. They can also restrict you on what you should do with the money they have given to you. They can tell you that you have borrowed money for construction of a school. It should work on the construction of a school. You shouldn't divert that money maybe to another project. So those are covenants, restrictive covenants. So if these are many, then you are automatically going to be forced out not to go for debt, and you look for equity sources. So if the security they want is too much and you can't afford it, you just go switch and look for equity. The other is, we can look at the level of gearing. The gearing is basically how the business is leveraged, like how much debt does the company have. Like, you can have more debt and maybe no one can actually give you another loan. So if you are at that point, then you should go for equity, because we have when those banks are lending to you, there is a maximum. They can tell you that our maximum, maybe we can give you 1 billion based on the assets, or we can finance maybe up to 70% of your assets that you are securing against those loans. So this will be the ceiling. So if you have already reached the ceiling, maybe you are at let's say 65% of your assets. No, it means you are highly geared. You have more debt in your capital structure, meaning no other company will be willing to give you more debt because you are highly geared. So you'll have to go for another option of looking for equity finance. So those are some of the different factors that will influence someone's capital structure. So I want us to look at, in the next video, we are going to be starting with the financial markets. We want to start on financial markets. We look at the different aspects that we are going to cover there. So let's meet in the next video as we're looking at financial markets.